Welcome to Columbus Brick by Brick, the podcast where we uncover the people, projects, and ideas shaping the future of our city. And each brick has a story, and we're here to tell it. I'm Jon Styer, the broker and owner of Styer Real Estate Professionals, and each week we sit down with local leaders, business owners, and community members making an impact in Columbus. From real estate and development to business and investing, we break it all down brick by brick. So today we're diving into the world of real estate investing, syndication, and business growth with someone who's been in the trenches and built success from the ground up. My guest today is Haydn Zeis, a real estate broker, investor, syndicator, and the principal of Lonicera Investments. Haydn helps investors navigate the complexities of syndication, market shifts, and long-term wealth building through strategic real estate deals. We'll talk about his biggest lessons, the mindset shifts that helped him scale, and he'll share where he sees the market heading and what investors should be paying attention to right now. If you're passionate about Columbus and where it's headed, you're in the right place. So let's get started. Well, Haydn, thanks for being with us here today. Happy to have you on the podcast. Excited to learn more about you and what you do and go from there. So why don't you tell us a little bit about who you are, what you do, and all that.
Great. Well, thanks for having me. Love the setup you've got. This is exciting.
Thank you.
So I'm Haydn Zeis. I am one of the principals and co-founders of a company called Lonicera Investments. And simply put, we syndicate real estate. Syndication, for those who don't know, is really just pulling people's money together to go and buy assets that you normally wouldn't purchase yourself. So sorts of things that we invest in are office buildings, flex, industrial, and we go in and we buy these assets that are underperforming and raise money from investors and then pay our investors a return, from the rental income.
It's a different method of investing.
Different method of investing. It's very, as you know, as a fellow investor, investing, I think a lot of people think that, hey, we're going to buy a piece of real estate. It's passive. We're not going to have to manage it. And in some cases, that can be true. But what we do is we buy assets that need to be actively managed and allow investors to invest alongside us very passively.
Can you explain to me what you said there, the need to be actively managed? What's the difference there?
Well, I think you could go out, anybody can go and buy a Chick-fil-A. And that's pretty much a truly passive investment, but it's a lower return. If you buy properties that, say, an office building that has multiple tenants, one of the buildings that we like to go after are office buildings. Think an 80,000 square foot building with 40 tenants. There's a lot of management that goes along with reviewing leases and managing tenant needs, just managing the maintenance of the buildings themselves. So you buy an asset and then you need to actively manage it to be able to produce the income and get the property producing the income to its fullest potential.
Perfect. Okay. So you work with investors who they want to be passive. You're the active piece of that. Is that what I'm hearing?
Exactly.
Okay. And now you're in Columbus. We're here in Columbus. Do you just invest in Columbus or do you invest nationwide or how does that work?
Yeah. So we started out in Columbus. We're based here in Columbus and we actually are working in Worthington. So pretty close to here. When we first started investing, we started buying flex, industrial, and office buildings. We put our first fund together here in Central Ohio. As we started growing, we started buying in different states. But we're staying in the Midwest. And what we know the Midwest very well and know how all of the markets are fairly similar when we're talking about larger cities in the Midwest. So currently we own property in Minneapolis, Indianapolis, Cleveland, and Columbus. And we're looking at in other cities, Cincinnati, Louisville, and we're going to continue to invest in the places that we own property.
So you like the Midwest because you kind of can wrap your head around it. It's similar. you're close enough, but you're not going to lock yourself down to any one particular city or market.
Right. And I think that's because of the way that we're structured. We don't do the property management in-house. So we utilize third-party property managers. So we can go after deals that are good deals in many different cities in the Midwest because we, like you said, we understand it. I think one of the reasons that we like the Midwest is the highs, they're not as high as the, East Coast and West Coast cities, but the lows aren't either. So it's more of a steady market, and if you're looking for cash flow, the Midwest is a really great place to invest instead of investing for appreciation.
Right. The risk reward. Yeah, that makes sense to me. So let's back it up. Tell me how you got started in syndication, why you chose the strategy you did, and some things you've learned along the way because of that.
Sure. Well, I got started in real estate over 10 years ago. Like many of us, started learning on Bigger Pockets and started listening to those podcasts. And I was really interested when somebody relatively young would talk about how they have 300, 400 units under management. And I just thought, how can you do this? So, in 10 years ago, I bought my first investment property, and it was a house that I lived in it, and I flipped it over 2 years, worked on it. I had a W-2 sales job, and I put together a spreadsheet one night that essentially showed what it would look like if I purchased one property per year and reinvested all the rental income back to buy the next property. Then I could buy 2 a year, then 4 a year, then 10 a year. And I, very similar to compound interest, it's the same in real estate. So I thought, okay, if I did this over a period of 20, 30 years, you can truly create generational wealth. When I started looking at deals, I really was researching many different avenues. I knew I wanted to go into real estate, and my parents actually really encouraged me to just go into real estate full time. Didn't know what I was going to do. I started out at a boutique brokerage where I was exposed to residential, I was exposed to commercial. My background in business-to-business sales and my W-2 position really, I think, it was more of an analytical type position, so I was attracted more to the commercial side of things. So I started pursuing commercial type deals, but as a broker. So one day after I created that spreadsheet and realized what real estate can do for you, and having listened to hundreds and hundreds of hours of podcasts, I decided, hey, it's time to I'm going to jump from my W-2 job, take the leap, and go full-time real estate. It was scary. I was going into a full commission paid. My wife, Colleen, she was working as a nurse. And so we didn't have kids at the time. It was the perfect time to jump. Got on her insurance, and then we had a little nest egg from the house that we sold, and we started purchasing, purchasing commercial properties myself while simultaneously working as a broker. And so as a broker, I was exposed to, I sold a car wash, I sold a golf course, sold, office buildings, and I also sold just purely investment, warehouses. And so what I was learning was I was going through, I had a small handful of clients as a new broker, but, let me back up and say, if any of the people watching this are considering making the jump, just believe in yourself, because if you go to work and you work every day, you're going to be able to probably make more money in your first year as a broker than you did at your previous job, and that was the case.
There's no cap.
There is no cap, truly no cap, and you get exposed to a lot of different things, and no day is the same.
Mm-hmm.
The one thing, as I was brokering, I was exposed to leasing. I was also, like I said, buying some of my own commercial properties, so I was doing the leasing there, really learning the business. And in real estate investment properties, if you are buying investment properties with the intent to lease them and live off the cash flow, leasing is the number one most important thing.
Mm-hmm.
Got to buy the property, get it leased up.
Right.
And so we were doing this, and I was really learning how to analyze properties for investors.
Sure.
And so the small handful of clients that I had, as I was in helping them purchase these assets, I was seeing the immediate equity that they earned just by me leasing the property up for them. So we would buy a property that might have 70% occupancy, and then I got it to 100% occupancy. And I mean, one investor, he purchased a property that had that vacancy. His equity immediately went up by millions of dollars by having the property leased up.
Now, can you explain the method of that equity creation for someone who might not be informed on why leasing a property will increase the value?
Sure. There's different appraisal methods, but the one that we're talking about is the income approach. And in commercial real estate, you could buy a property as an owner user, or you can buy it as an investment property. And if you're buying it as an investment property, you need to focus on the net operating income. The net operating income is what drives the value of the property. Capitalization rates, which is a quick way to measure the property, really the risk of the property, but also the return that you're going to earn from it, is how we determine the value of a property. So if you buy a property that has 0% occupancy, that means it has zero income. Mm-hmm. So if you say a property has zero income, well, and you're valuing it based on the income approach, the value is technically zero.
Right.
But if you go and you look at the property and value it after it has $200,000 worth of income, that same property at a 10% cap rate is now worth $2 million. Mm-hmm. So the value is created by the income that it produces. So in the case that I had just described, we purchased a property with an investor. He bought it at 70% occupancy. We increased the income by 30%, and the value of the property immediately increased proportionately to the income that it was producing.
Right. The income approach, I often liken it to you're buying a business. You're buying real estate, but it's also a business.
Yes.
And so when you consider how much does the business make, that drives how much it's worth.
Yeah, exactly.
The asset has value, but the real value is in operating the asset.
Exactly. And that's what, our investment thesis when we go and we purchase properties is we target properties that have low occupancy, but that is typically when you have a building in a nice area that has low occupancy, that means that it's not being operated correctly. So we try to buy properties from owners who are approaching retirement or owners who might not be paying attention to the property, might be too small for them. We've bought properties from very large owners of real estate that is this something it's just too small for them to pay attention to.
For them to worry about.
So I say, I'll live off your scraps all day long. So, we go after opportunity, we go after problems, and we try to fix those problems. We've had a lot of success. Well, a property that we purchased right down the street from here was completely unoccupied, 0% occupancy. And what we ended up doing is we fixed it up. It was I think we bought the property for $350,000. It was a It's an 8,000 square foot medical office building right across the street from Riverside Hospital, which is one of the number one hospital systems in Central Ohio. And so the location was good, 0% occupancy, and it needed a ton of work. I think we put, $700,000 into it. But once we took the property and executed our business plan by putting tenants in it, we got the property up to 100% occupancy pretty quickly. And then the property appraised for $1.8 million or $1.6 million.
So you generated almost $800,000 or $600,000 in
exactly.
value.
And that was due to buying the property at 0% occupancy and putting some money into it. But we worked the plan and we're able to increase, our net worth by a significant amount right off the bat.
I love it.
Yeah. And it's a finding those deals, they don't come across your desk too often,
right.
But when you see them, you've got to, you go after it pretty hard.
Right. So I'm hearing that part of your strategy is you're taking on some risk. You're taking on risk with the knowledge that you can take this property from down here and bring it up to here. How do you manage and mitigate the risk, especially when you're bringing in investors and you owe it to them to make sure that you do a great job?
So good question. And I would say that one thing I did not describe within our strategy is we put together syndicated funds. So essentially, to mitigate risk, we might couple a property. The property I just described was a personal property that was not syndicated. Another example of a property that we purchased, I'll give you an example of properties that we just purchased recently that a strategy that we'll go after is we'll buy something that is stabilized. Maybe it's 100% occupancy, has decent cash flow, and then couple it with a property of 50% occupancy, and then increase the income on the property that has 50% occupancy. So what we're essentially, we're hedging our bets on, we're buying a stabilized property that's in a good area that has a stable tenant for several years. Then we're buying a more risky property, putting them together with the same investors so that you're essentially, you've got cash flow immediately, but you also have a significant amount of upside from the one property that has lower.
So you're moving the meter on the risk reward a little bit.
We are, and that's a strategy that I like to take when we're working with investors, because when we have investors that put their money with us, I do not want to, we're not going to put their money at risk to the point where we think that we're going to lose every dime. So we like to hedge the bets by coupling it with something that's a little bit more stable.
I can imagine that gets a good response from potential investors for you.
Well, it does. And I think one of our we like to have multiple tenants. There's many people that will buy properties where you have one single tenant in a, 500,000 square foot building. We like to buy, like I said, an office building, 80,000 square feet, 40 tenants. It's kind of like you're buying a mutual fund with all these tenants because every tenant is in a different industry. You've got lawyers, you've got doctors, we have dentists, we have therapists, we have nonprofits. Every different type of industry is, represented within our tenant base.
So you're able through that strategy to kind of operate with a diversification within one investment.
Yeah, exactly. I think that's kind of our pitch when we pitch it to investors is if you're investing with us, you're investing in diversification. And that not only goes with the tenant type, it also goes asset class, because the last fund that we put together was, it's got about 500,000 square feet of office, flex warehouse, and industrial. So we're in different cities. So we're diversifying through location, through tenant base, and asset class.
Interesting. Can you tell me a little bit about syndication in general, how that works, what might be an expectation for someone who is interested either in investing themselves or starting a syndication?
Sure. So I'll preface this by saying I'm not an attorney, right? But whenever you are using somebody else's money, essentially it becomes a syndication. And so if you were syndicating, and if you were the general partner, that's what I'm, general partner or sponsor, you are the lead on the project. If you bring outside money in, and that outside money from those investors, those people are intended to be silent partners and have no day-to-day responsibilities, essentially you're syndicating.
Yeah.
And one of the things that you do from a syndication standpoint is you're leveraging other people's money to be able to go out, like I said earlier, to purchase real estate that you might not purchase on your own, and that's done. It's done for many different reasons, but as a sponsor, when I was brokering, and you may have had these similar experiences, people see the success that you're having as you're buying rental properties. And then you start to get family and friends that are interested in doing what you're doing. Well, we can do that, but you have to do it legally.
Right.
And following the syndication method, you're essentially, syndication is a security. It's an exempt security, but it is, we run under Reg D 506B, and it is something that, this SEC, looks after. So you have to follow a lot of rules and regulations to do it. Now, all of that said, it shouldn't be scary because you can hire a very good syndication attorney who specifically will create your documents to you be able to follow the rules that are, set forth.
Totally. And so I can imagine for your first syndication, it was probably a little bit scary.
Oh, sure.
Can you talk to me a little bit about that and how did you overcome that? We talked about jumping in, right?
Yeah.
And you jumped into being a broker and helping people buy and sell commercial real estate. And then at some point you jumped into syndicating.
Sure.
Did you have a mentor? How did you navigate those waters?
When you're syndicating, you're really running 3 different businesses. You're running an investor relations business because you're always bringing in limited partners. The limited partners are your investors who that's the money that you use to go and purchase the properties. So each quarter you're interacting with them, sending them a newsletter, keeping them up to date on their investment. And then you've got asset management. That is running the assets, and that silo you are dealing with the property managers, you're dealing with the leasing agents. You're really focused on helping the individual asset perform to the goals that you need it to perform to. And then you have the brokerage or the property management side, and that is where you're trying to find properties, drumming up business, and finding the deals that can go into the pipeline. But, to answer your question of how we jumped right in, it was a slow process. I think it took many years of really understanding leasing, understanding brokerage, understanding how to analyze a deal for my investors, seeing how my investors that I was dealing with as a broker, how did they analyze deals? So I built a model, my very first model, I got a hold of somebody's PPM and private placement memorandum and their operating agreement, and I read through it. And it's 180 pages of legalese.
Yep.
But within those documents, it tells you how you pay your investors, how you, as the general partner or sponsor, get paid. And so I read that, built the model based on those, these syndication documents that I read, and started practicing analyzing deals. And so I looked at a deal, put it into the model, said, okay, these investors are going to get 10, 12% return. How can I do this? Could I achieve the plan? And as I would practice analyzing these properties, I would then follow these properties and see what they sold for.
Nice.
See how maybe it was a year later, did the property resell? How much did it sell for? What did they do? And as I started to understand, was my plan similar to the person that actually bought the property's plan? And I was able to see, okay, this is something that can truly work. So as I started ramping up, I'm much younger in a different financial position when I started. So you have to partner with people that can guarantee debt. You've got to partner with people that have more business experience. And I took on additional partners. Mm-hmm. And those partners were mentors to me as we continued to grow the business. And when we decided to start the business, we sat down with multiple syndication attorneys and we tried to get a feeling for how can we put together our documents in a way that keeps us safe, keeps our investors safe, and follows the rules and regulations that are set forth
by
the government. So I wouldn't say that jumping in as a syndicator was something that we just did. It was a lot of planning. From the time that we formed the company to the time we purchased our first property was over a year. And it was a lot of analyzing, planning, mm-hmm. making sure that we had everything, put together, ready to go to be able to, be successful. And after we actually just sold some of the assets from our very first syndication.
Congratulations.
Thank you. Yeah, last year we did that. We still have a couple assets that are producing income that are within that first fund, but it was a great win. We outperformed, what we told our investors we would do. We sold the properties for more than we expected we would, but I credit that to my business partners and me being incredibly diligent mm-hmm. in those, in that initial, setup period where we were trying to create this business. Mm-hmm. So, that's a long way to say, if you're planning to start syndicating, you should, but you should be incredibly careful.
Yes.
You should plan it out because you're dealing with investors' hard-earned dollars.
Right.
And these investors want to know that you didn't just find a property, put it together, slap a model together. They want to know that you actually have a truly executable business plan because, like you said earlier, we're buying little businesses and you have to every different property has its own nuances mm-hmm. that you need to be careful when you're putting it together. So
totally. I find that in working with investors, I personally love working with investors because they want to keep investing, right? Yeah. But the important piece of that, and I'm sure you would be the first to agree, is that your reputation in working with investors is so important. To be able to get that repeat business, you have to be successful. You have to be able to point to past success, and you have to be able to provide success. So your diligence is so important, and I commend you on that for knowing and then proving that it is so important. It is so important.
Oh, well, thanks. I mean, touching on that subject, I think when you're starting out as a new investor, or if you're trying to syndicate, or if you just want to be an LP, I think the general partners is the most important piece because mm-hmm. they're going, you as a limited partner are investing silently.
Right.
You have very little say in you have no say pretty much in the day-to-day operations. And I think when you go in, you want to know that the general partner who's running the deal has a plan. They have a track record. Mm-hmm. In the earlier years when you're investing starting out, you don't have a track record.
Right.
So you're investing with people that trust you as a person.
Mm-hmm.
So those friends and family come in and invest with you. Once you start executing that business plan and following it and staying true to your word and sending, your monthly or quarterly distributions, then you start building that track record.
Put your money where your mouth is.
Exactly. And, one of the statistics that we try to convey to our investors is all of the cash that we continue to send back to them. And it's something that makes me incredibly proud to say, we've paid our investors over $1 million back into their pocket from these investment properties that we've purchased. But, your reputation is everything in this business, whether you're a broker, a syndicator, a title agent. It's a small world, and everybody has a feeling for who you are as a person. But be true to yourself, and follow your business plan, and you'll find that you'll be very successful.
Yes, I love that. Well, as we start to wrap up here, I would love to get some advice from you, just for everybody. What would be one piece of advice that someone maybe is interested in getting into syndication should take to heart?
So I think if you are a limited partner, an investor wanting to invest into a syndication, like I said earlier, knowing the sponsor comes first, then understanding the deal. So if you want to invest passively, if you have your high income earner and you want to put money into real estate and diversify, know who you're dealing with, because not all syndicators are created equally. Understand the type of asset class that you're going into. Is it multifamily? Is it office? Is it warehouse? What are you going into? What's the business plan? And does that meet your goals as an investor and your return expectations? If you're looking out at starting a syndication, make sure that you truly understand that you are working with other people's cash that they have worked very hard to earn. And focus on your plan. Focus on what will go wrong. We can all pencil a deal to make it go right, but stress test it. Look at the deal. Make sure that you have what happens if you lose the largest tenant in the building in year 2 when you weren't supposed to. What happens when COVID hits? And, stress test your deals to say, what is the least amount of occupancy in the building that I can have and still be able to pay all of my expenses and my mortgage payment. And if you feel comfortable with that, and your investors feel comfortable with that, go for it. But I would say plan for the unexpected, because it always happens.
Yep.
If you're going to invest as a syndicator, make sure you build reserves into all of your models, because those reserves are what are going to save you if something terrible happens. And it's real estate. Things don't always go right.
Sure.
And we have never had a pro forma that goes exactly as planned. It just doesn't happen that way.
It's a best guess.
It is a best guess, and you use it based off of the statistics that you learned through the many years. You track statistics, how well is leasing doing this month in this particular area. All of those things, put it into your model, understand it, and then if you do, and you truly understand where you need to be, you're going to be successful.
Yeah, I love that. Thank you. So as we wrap up our conversation here, I would love to hear a little bit about the future.
Sure.
What's in the future for you, and what do you see is in the future for the market in which you operate commercial real estate here?
Yeah, so all good questions. I think we're continuing to grow. We are a small company. We own about $70 million worth of real estate, and we are focused on growing, but growing in a very smart way. I don't have a particular goal of assets under management for a particular year. I've got a goal of owning good assets.
Mm-hmm.
And one of the things that we will do is, we're looking at expanding in the markets that we currently own property. Particularly, I like the Cleveland market for many different reasons, in the Minneapolis market. Those are growth opportunities that I believe that will have success. As we continue to grow, we'll continue to hire, and we'll continue to build upon our success. And I think being very focused on building the business to be strong, stable investment opportunity for potential limited partners is really our goal. We want to be able to be that alternative investment for the limited partners, and
Mm-hmm.
be incredibly open and transparent with them. So those are all goals that we have to continue with our business, growing it and being as sustainable as we can. From a standpoint of where I see the market going is a tricky one. If I knew that, you'd
already be on the beach, wouldn't you?
Already be on the beach. But what I'm seeing in the market is office particularly is doing better.
Mm-hmm.
There's a number of reasons. I'll give one example that's local to Columbus, or where we own property. We own, a large office building in an office park that has about a million square feet total of offices around. Recently, about 300,000 square feet of that office came off the market. It was just office that was tore down, and apartments are being built.
Mm.
So what we're seeing is the conversion of office and office being tore down. And we are seeing that leasing activity is starting to pick back up in the larger spaces.
Mm-hmm.
We specialize in spaces that are about average square footage of 2,500 square feet or below. We're starting to see activity pick up in the 5,000 square foot spaces, the 10,000 square
Mm-hmm.
foot spaces, and larger users are coming to the market. So I think office, as work from home dissipates, we'll start to see occupancy slowly increase over the next few years. From an industrial and flex component, the flex warehouse, which a lot of people define it different ways, but the way I define it is small space that can either be a little bit of office or a little bit of warehouse, or vice versa.
Mm-hmm.
That small bay product is incredibly stable, especially in the Class B asset class.
Mm-hmm.
It is staying full. Occupancy rates are staying in the 2%. The vacancy rates are in the 2% range,
Which is awesome.
They're in that 2% is just unoccupiable space. It's space that's run down.
Mm-hmm.
So we're seeing that's staying strong, and that's one of the asset classes that we're focusing on to purchase as the stabilized asset class when we're buying more distressed assets. When we're looking at industrial, larger industrial Class A vacancy rates are increasing, but we went from 98% occupancy to 95% occupancy. So I think that that's not something that we buy. It's just something that we're observing, which
Mm-hmm.
does affect the next class down.
Right.
So because when Class A struggles, the rental rates are going to go down a little bit,
Mm-hmm.
and that'll put downward pressure on the Class B, which is what we purchase. But so we're starting to see the occupancy rates decline a little bit in Class A. Class B is still staying strong, and rental rates are still increasing. So I think those classes are gonna continue to produce well. interest rates. That's always on everybody's mind. I don't know what's going to happen. What we're planning for and what we are underwriting is increases. And I don't know if that'll happen, but I'd rather plan for it.
Why not be conservative?
And I think what, over the last year, interest rates have stayed much more stable than they were for the previous years. So we're going to see, I think that when we're underwriting deals, we are saying that interest rates are going to go up a little bit over the 5 years, that your loan until your loan matures. So nobody knows what interest rates is going to do, and if you say you do, you're lying.
Yeah, yeah. I mean, completely. There's just no way to know. So you said one thing I want to ask about it. You mentioned a 5-year loan balloon. Are you exiting usually at the end of that, or are you just assessing and deciding then? How does that work for you guys?
So we're assessing and deciding then. I think, we like many others have loans that are in the 3s. And, I was actually on the phone with a banker of a office building that we own. The loan matures in September, and we're planning for rates. I think right now, that rate is going to go from 3.5% to 6.5%. So it's a significant increase. However, during this time, because of the type of properties that we have purchased, properties that have lower occupancy, our cash-on-cash return is pretty good, so we can sustain...
Bake it in a little bit.
We can sustain a little bit of a hit, but... Also, when your loan matures, that also gives you the opportunity to assess whether a cash-out refi is what is the best situation.
Sure.
And in this case, we're looking at one property where we purchased it around $4 million. It has increased in value to probably $5.5 million. So we're considering doing a cash-out refi, and we would be able to take out about $1 million and give it all back, give our money back to our investors per our operating agreement. So then our investors still own a really good asset that has stayed at 95% occupancy since we've owned it,
right?
And get to reap the reward of the cash flow that's still coming in. Although you're paying a little bit more of a higher mortgage rate, but you're still paying principal down, and 6.5 is still pretty good.
Right.
So, depending on the deal, 5 to 7 years is our typical hold period. However, there are deals that we will look at to sell sooner than that. Just depends on what the market needs. And that's one of the things that as a general partner or a sponsor of these funds, we're constantly assessing, because we want to make the best decision for our investors and get the best return for them. If we have a very good asset that's producing great cash flow and staying at a high occupancy, but office right now, for instance, people don't love it. And it might not be the right time to sell until banks are more looking at office in a more favorable way. So holding on to it beyond that 7-year period might be the best strategy. And those are all things that we're assessing now.
Perfect. Yeah. I love it. You're a wealth of knowledge. I know that we could sit here and talk for another hour. So we'll have to have you back.
I will be happy to be back.
Awesome. Well, where can the listeners find you?
So LinkedIn is the best place to find me, or you can check out our website and you can reach me there. You can put my email address in the link in the bio, and we'll feel free to reach out with any questions if you want to invest or if you want to learn about syndication. Happy to talk to you.
Awesome. We'll be sure to share all that stuff so that listeners can easily find you. Thank you so much for sharing all this.
Thanks for having me.
It was awesome. Really appreciate it. And look forward to the next time.
Great. Thank you so much.
Awesome. Thank you.
All right.
So that's a wrap on today's conversation with Haydn Zeis. What an insightful deep dive into real estate investing, syndication, and business growth. So his journey and expertise really highlights how strategic thinking can shape long-term success. So if you guys enjoyed the episode, please be sure to subscribe, leave a comment, and share it with someone else who you think might find it valuable. You can connect with Haydn and learn more about him on his LinkedIn, which we'll link in the bio, or his website, lonicerainvestments.com. So thank you for tuning in. I'll see you next time as we are uncovering the stories behind Columbus's growth, one conversation at a time, here on Columbus Brick by Brick, where every brick has a story, and we're here to tell it.